Hey, everybody, this is Charles Dobbins, the multifamilyattorney.com, and your host for the Multifamily Investing Podcast, one of the fastest growing multifamily podcasts in the history of the world. And on today's show, I get to interview Travis Watts. Now, Travis Watts is a full-time passive investor, okay? He is strictly passive. The guy has never sponsored a deal. So you get a perspective from an actual investor. He's been investing in real estate since 2009, both in multifamily, single family, and vacation rentals. He is currently the director of investor relations at Ashcroft Capital. And if those of you don't know what that is, that's Joe Fairless's organization. So he's invested in over 25 passive syndication deals in 14 different companies. He now dedicates his time to educating others in the world of investing, and he's made it his mission to share passive investment strategies in order to help others achieve wealth in multifamily. So sit back, grab yourself a nice cup of coffee or a cold one, and enjoy my conversation with Travis. It was a lot of fun, as it usually is. Enjoy. Travis Watts, welcome to the Multifamily Investing Academy podcast.
Hey, Charles. Thanks for having me.
Yeah. Keep the, do you maintain those vines behind you?
I do. Yeah, I water them. They're made of plastic, but they do require water. Yeah.
I think we have the same genius.
Oh, I love it.
Yes,
it's
exactly.
it's like an IKEA setup or something.
Oh my gosh. I was just going to say, that's exactly where we got them from.
Yes.
Oh, that's classic. But you need these. You gotta get these.
I know. I don't have any motivational quotes, right? I got
this one. This is my new one. I love this one.
It only takes one yes for success. There you go.
Yep. That's what we just find that one's property, and then you're off to the races. It's a company called Iconic, and it's like IKONIC. They have phenomenal, really high quality stuff. It's not like your cheap stuff. I don't buy cheap. I don't buy cheap.
Yeah. There you go.
I can tell by the type of vines behind you. You buy cheap. So
yeah. Don't know if I can agree with you there, but
exactly. Hey, Travis, I really want to, you've got some good things I want to talk to you about. So let's get started. First off, I did the math, and you left your W-2 job after working 98 hours a week, which for those of you at home boils down to 14-hour days, 7 days a week. And that kind of reminds me of my old insurance days, and just dreaded it, hated it. What were you doing?
Yeah. Good question. What was I doing? I think about that all the time.
Yeah. I mean, like, what type of job was it? I mean, were you finally left a brain surgery business? Is that what it was?
No. So kind of a funny story. I was totally not made for this industry, but I took an oil field job just because of the pay. It was solely just a paycheck play, and I was living on peanuts.
You must have blended.
Yeah, right.
Yeah,
you can just see me, right? The sledgehammer guy. So
exactly. What the heck? Where was that? Down in Texas, or?
Actually, I got started in Colorado. That's just where I grew up. That was kind of the highest paying opportunity I could get into at the time. And it led me to some overseas work. So I actually ended up working in the Middle East and Saudi Arabia and Kuwait a little bit.
Okay. So, well, you weren't there when they were trying to stop the oil fields from burning, were you?
No, I wasn't. So I wasn't there overseas very long at all, actually. But that was kind of the last stint. And then
well, let me ask you this. When you work, part of the problem that people have when they work those kind of hours, and I can tell you, we face those people all the time. How'd you find the time to make the break to get into something else? What was your path?
Yeah, that's a great question. So the 98-hour weeks were working domestically in the oil field, which is a totally different type of oil field than you'll have in the Middle East. It's much slower paced over there. The reason I actually went that direction was because of the schedule. Here I was working, like you said, consistent 14 hours. You did have some days off if you didn't have to work or come in on your days off. Yeah. And over there, it was a 35-35 schedule. So I worked 35 days on, then I had 35 days off. That was the key to me being able to educate myself and figure out what I was going to do to get out of it.
Yeah.
So that was really the master plan.
And so give me some of the steps. Like what were the, how did you take it? What was the first thing? At what point? Bring me up to when you burnt the ships.
Yeah. Well, they were burning the whole time, but
Yeah, no kidding.
once I realized I wasn't going to survive that, right? After
Exactly.
age 40, I'd be dead. So
yeah.
that's how
That's
I
so
felt.
funny you say that, and you haven't been to one of my talks, but I tell people that when it all happened for me was when havoc struck, and havoc struck for me when I turned 40. And it's just something about that time. You just like, I can't do this for the rest of my life. I just can't do it. So yep. I hear you.
So, so I was playing in the single family space throughout this whole process of the oil field stuff, which was the wrong approach for me, because my whole desire was to build up my passive income and to be a passive investor. That's always what I wanted to be. But simultaneously, I was trying to do fix and flip stuff, and I was doing house hacking, renting out spare bedrooms. And then I got into the vacation rental space at the end because I had enough time to kind of pull that off, or at least part-time. And then my poor girlfriend, who's now my wife, she had to kind of take over for me. She was burning the ship too. And so it was sometimes.
Did she walk up to you with one of these?
It was, oh gosh, it's hard enough just to be away from home 35 days, but then to get all the phone calls about, this person.
Because that impacts her relationship with her boyfriend quite a bit.
Yeah, it was tough. It was tough on many levels. And so, the whole thing was just the wrong model, right? The oil field was wrong. The single family stuff was wrong. Having her have to do stuff she didn't want to do like that was wrong. The whole thing was bad. So I did a lot of self-reflection and a lot of self-education, both when I was working overseas, because it's very slow paced. There's a lot of downtime over there. And then when I was home. And so that was, real estate meetup groups and blogs and podcasts and books and all this kind of stuff kind of led me to discover there was a more passive approach to real estate, and it wasn't everything that I was doing. So I learned about syndications, real estate syndications, specifically in the multifamily sector. And so about 2015, 2016, somewhere in that range is kind of when I made the big shift. And I started selling off all the single family stuff. And I started just one at a time doing a syndication, usually at just kind of the minimum investment kind of thing. Yeah. And just built that up. I just fell in love with that model, just that concept. Like, I'm going to leverage someone else's time, connections, resources. They're good at what they do. I wasn't necessarily good at what I was doing. And I was going to be completely passive and have what I always wanted, which was just the passive income. That's all I wanted at the end of the day. So for me, that model made a ton of sense. And done, I don't know, 27 deals, I think, in the passive syndications as a limited partner. So that's what I do.
Have you been the lead? Have you been the sponsor on any deals yet?
No. And I don't intend on really doing that just because of the time commitment. And my wife and I love to travel, and, we move a lot, and we just kind of like that flexibility.
So you truly are a man of leisure.
I still go to a lot of seminars and meetups and things like that. There's still, some things that I do actively, but no, nothing like 100-hour work weeks. So.
Yeah, no kidding. Oh God, now I wake up in the morning. I can't wait to get to work. It is a blast. I love what I do. It is so much fun compared to what I used to do. But no matter how bad I say the insurance business is, I don't want to be in the oil field business either, man. You got me beat on that one. I'll tell you right now. So, all right. So, but you're now you're working with Joe Fairless. His company's Ashcroft Corporation, however he calls it. But let me talk a little bit about Joe Fairless. So, Joe Fairless, what's the name? And I should know this off the top. What's the name of his program? Like what's the name of his podcast?
Best Ever is kind of his branding. So Best Ever books, Best Ever conferences, Best Ever. Yeah.
So they finally took me kicking and screaming into the podcast business. They said, well, you got to come up with a title. How about the Best Ever Multifamily Podcast ever? And so they said, okay, fine, we'll do that one. So I came out with the Best Ever thing, and I got, an email from Joe. Hey, Charlie, can you kind of knock it off? And I said, oh, you're right, Joe, I apologize. You're right. Listen, I should have known. Yeah, I'll change it, but you have to come on my show. And so Joe is one of my first guests on my podcast a ways back. But what he doesn't know is I actually changed my name to Joe Fairless. So now no, Joe Fearless. I'm Joe Fearless.
Okay.
Yeah.
Gotcha.
Yeah. Just to steal it. Don't tell him, but he's going to find out the hard way. So yeah, I'm always chasing his tail. So now you're doing, so this is like is this your new gig is to, what do you do for Joe exactly?
Yeah, that's a great question. So, and that would obviously be a common question, right? If I'm a full-time passive investor, then what's that have to do with anything?
Yeah.
So basically, I've always been a big advocate for self-education, specifically in like the seminar space. I love attending events, whether we're talking about Tony Robbins or we're talking about a real estate conference. So I've always gone to these things, and I kind of found a win-win with Ashcroft Capital. So I'm part of their investor relations team, but what that specifically is it's about being at live events as a sponsor, for the event. So you'll see an Ashcroft Capital booth, and there I am, or maybe I'm a panelist speaker or something like that. So just
so everyone understands, that's where you and I met. Was you and I were both down at the MREX. MREX event down in Florida.
Yep.
So, what did you do there? Did you just own a booth, or did you get up and speak?
Actually, I was at that conference just because I was in Florida anyway, and so I was just attending that conference.
Oh, okay. All right.
But I just got back from LA. I was at Hunter Thompson's event, so the Intelligent Investor Conference, and so I had an Ashcroft booth there. We were a sponsor. So
Hunter Thompson.
Yeah. So he's with the Siam Capital. So he's got
the guy. Isn't that the guy that wrote like To Live and Die in Las Vegas or something? Or
no, different Hunter. So
wow,
yeah,
you guys got the same name. That's brilliant.
Yeah.
Okay, so what? So you take a look at all the deals, pretty much.
Right.
Okay.
Right.
Okay. So how do the deals come to you? You're the gatekeeper, essentially. Really, that's kind of.
I'm on a lot of people's deal list per se, right?
Yeah.
So as you network and you run into people and you're exchanging business cards, right? I'm on just about everybody's list. So
okay, so they call you up and say, "Hey, Travis, have I got a hot one for you?"
It's a daily thing. I'd say on average, I see at least one deal a day.
Okay.
So yeah, a lot of email, but yeah, a lot of phone calls too, and so. I'm totally open to those conversations. I don't invest in most, but you got to know yourself and your criteria and what it is you're looking for. So.
Okay, let's talk about that, because that is, I mean, I'm sure everybody listening right now is like, oh, okay. What does Travis look for in a deal? How can I get my deal in front of Travis and so that he says yes? What type of deal? And let's be realistic here. Of course, what type of deal are you going to say yes to? Give me some of the parameters.
Gotcha. Yeah. So it changes with the economic climate and kind of where we're at and liquidity and all that. But in general, I am a huge fan of B-class multifamily product.
Yep.
I've done some C. I've never done anything below C.
Do you know what I say about C-class property, Travis?
What's that?
I have a bumper sticker on my car that says "Life is too short to own C-class property."
Okay. Yeah.
I'll send it to you. I'll send you one.
Especially if you're the one managing it. So
okay. You know what? Yeah. Like, don't give me the PTSD syndrome, okay? Because I've been there, I've done that. I don't want to do it again. So
Okay.
Yeah. So everybody that's listening right now that knows what we're talking about is feeling our pain. They know the inside baseball comments that you just made. But okay, go on. B class. I'm right there with you all day long.
Yep. So no new development and things like that, and no D grade stuff. So the other thing, a value add component. So I'm just a fan in general of that model. I don't care if we're talking about real estate, multifamily, or like a car. I like the idea that I'm going to buy something cheaper because it needs some work. I'm going to fix it up. Now it's worth more and make it run again. Right. Kind of.
So essentially, everybody listening, what Travis is talking about is the exact same way that Warren Buffett made his billions. Is you buy a cheaper product and you add value to it, and that's what how Warren Buffett did it, and what Travis is talking about. That's how we do it in real estate. Now, Travis, let me ask you this: how do you define value add?
It's a good question. value add's a huge spectrum. I mean, some people would say it's a value add. We're going to gut every unit and get everyone out of the property, and we're going to start over from the studs, right? That's quite heavy. I wouldn't invest in something like that unless it was a very experienced team that's done that over and over, and that's just what they do.
Yeah.
But I like the light value adds. What are we talking about? Just stuff like improving the units in general, new paint, new countertops, new floors, stainless appliances, green initiatives with, LED lighting and stuff like that. Rebranding is pretty common. Just because usually there's some negative connotations that go along with the old name of a project that's
especially
gone south.
Especially when somebody like spray paints, R.I.P. Joey on the side of the wall, then you kind of want to. And for those of you at home, if you're looking at a property, I highly recommend you take the address of the property and stick it into Google and hit enter.
Yes.
And if you get any news stories about murders on the property, you might want to think otherwise, because sometimes rebranding doesn't even work in those examples. So, now, okay, so I like how you said, gut to the studs. It just doesn't work. But I just had a student. I was analyzing a student's deal just this morning, and he's got money going in to rehab the property or to do, renovate the property, but I'm not seeing any bang for the buck. So in other words, you can rehab, but if you can't get your rents any higher after the rehab, why do it?
Yeah.
So,
right.
I mean, like, what do you look for as far as, when you think about doing those light rehabs? You're not going to do it unless you're going to get something more out of the rent.
Yeah.
So right. What's your plan when somebody comes to you with a deal? Tell me how you analyze it as far as how are you sure that what you're looking at can command that higher rent? What types of tools do you use on the internet to show, okay, like Rent-A-Meter, Anoto, what services do you use to make sure that your rents, when you're done, will fall in line with the market?
Yeah, that's a great question. And so the first thing I'll say probably won't apply to many, but if this deal is accessible to you in person, so maybe it's in your own backyard, maybe it's a Dallas deal and you live in Fort Worth, go walk the property, right? And then not only that, go walk the comps in the area, right? What are the other properties surrounding it doing that they're not? What could be improved or better about this property? You can also do some of this research online, but give you an example. One of the recent deals that I invested in, it was like over 500 units, and their gym was like 2 treadmills and a couple sets of dumbbells. And the complaint among all the current residents is that we can never get in there. Number one, someone's always on the treadmill. And then, when you do, you're cramped in this little space and it's awkward. It's just, It's not a good fit. So one of the value add plays on that property is to knock down a wall, double the size of the gym, put all new equipment in it, and make that an adequate workout facility for 500 residents plus. So that would be a type of value add that I think as a prospective renter, you're going to see that. And now all of a sudden it really does mean that there's a gym on site, not a potential to maybe use a treadmill if you get lucky. So,
I tell you, I had one that I was looking at, and the decor of the gym looked like something right out of the Partridge Family. And it's like, applique stickers, like, oh, come on, really? Who uses that? So, yeah. And how about, the new thing that everybody's talking about are package rooms?
Yes.
Unreal how those have just transformed.
Yeah, absolutely.
And the technology now behind it, it's unbelievable. And for those of you that don't know what I'm talking about, it's all about Amazon. It's all about Amazon, and very cool stuff. So what markets do you look at right now? Where do you see, and I'm going to talk to you because I love this next question I got for you, but we're going to dig down deep into the market. But where do you look right now?
Yeah. So what I do personally is, I brainstorm with my wife and we kind of we go very macro level, very high level bird's eye view across the United States. Where do we want to be investing? So I'm looking at things like, where are people moving? What are the migration trends? Blah, blah, blah. So I think at this time, number 1 and number 2 are Texas and Florida. So those are two, but that's too generalized because you can't just say every deal in Florida is a great deal. Same with Texas. So we kind of zoom in like that from a high level, and we start looking at groups doing deals in those states. And then we let them kind of fill in the rest as to what specific submarket they're going to invest in and why they're so bullish on that particular submarket. Maybe Dallas as a whole has projected growth of whatever, 4%, but this submarket is projected to grow 7%, so therefore maybe that submarket's worth considering. So we let the groups kind of fill in the gaps. I don't do extensive research on market analysis, but I kind of generally know where I like. So.
All right, that just killed my next question then.
I know, we're going deep, right?
No, I wanted to go deep with you, man. I wanted to really, really get to know you, Travis, on my first date with you here, but you're telling me you're in it for something else. Okay, so what do you think about this market?
This market, as in just as a whole, just macro level?
Multifamily market, yeah.
Gotcha.
Yeah.
Lot of capital chasing multifamily.
Yep.
Both institutional and private. What's kind of interesting to think about, someone pointed this out to me, is probably at an event that I attended, but so if you think about being like a pension fund or an insurance company or, deep pockets, right? Going out there looking for yield, think about all of your choices out there from where we are in the stock market right now and what could happen there, where, bond yields are, where CD rates are, where, what banks are paying. It's a low yield environment is my point. So when you look at cap rates on multifamily, and let's say it's a 5 cap, well, for some, they're going to go, 5 cap, that's terrible. I'm not, I wouldn't buy something that's a 5 cap. But for, when you're looking for yield, with deep pockets, 5 sure beats 2, right. And it sure beats 3.
With that spread between the cap rate and the yield, it's still makes multifamily incredibly attractive. Yeah. And I tell you, this economy, I heard, one of these gurus say that he's staying out of the market waiting for the next correction. I got to be honest with you. This is because you got started, 2016, 2015. I've been through enough cycles before that I've seen good, the bad, and the ugly. Yeah. And the last cycle that we were in is nothing like what we're in today. So if you're thinking you're going to have another correction like happened back in 2008, it's not going to happen. It's an entirely different world. And if there's a correction, the multifamily world is going to have its own correction, which will be totally separate than what the stock market does. Because the stock market, hey, that right now they have their own game going on, but multifamily is a different world right now, and it's all because of the demand for our product. The demand for our product is so high, and I'm talking about apartments, the actual units. The demand for our products is so high. And it's just continue to grow, continue to get even bigger, that they're not building them fast enough. I'm actually, Travis, my next gig is building. Okay. I think that's the next route. There's a lot of free money, and it's not free money, but it's cheap money that for building. And then it's the problem is just finding those markets where the government lets you build.
Yeah, right.
That's part of the biggest problem is the government just is, Hey, you want to hear something? I spoke in Connecticut a little while back, and I mentioned Donald Trump twice, okay? I mentioned Donald Trump in a joke that I have been telling for years about my liberal son and how I use Donald Trump to my advantage against my liberal son. Everybody laughed. It was a very funny joke. Yeah. And if you come to one of my talks, you'll hear me say it again. And then the second time I talked about Donald Trump was in a reference to a guy that I used to coach like 10 years ago. And how I referenced Donald Trump, who wasn't even a candidate back then, in this conversation. Some woman comes up at lunch and wants her money back because I talked too much about Trump.
Come on.
Are you kidding me, sweetheart? I didn't even talk about Trump, but it just goes to show you nowadays, it's such everybody is so polarized. It's amazing. So,
agreed.
Agreed. Yeah. but and then I had a reminder that I talked about Jimmy Carter too. So I didn't get any credit for that. So much for that. So
It's a one-sided coin.
it is. It is. All right. So let's talk about, one thing you talked about was the lessons learned from single family to multifamily. What are some of your experiences from making the transition? Because you said you started off doing single family, and that's the majority of my students are coming from single family backgrounds. That's where they learned, that's where they cut their teeth, and they're all dying to get over into multi. And even if you listen to Than Merrill's commercial to come to his event, he says, I'm going to teach you my formula for single family so that you can get into cash flowing multifamily. It's like, well, why don't we just skip you and go into multifamily?
That's hilarious.
Who needs you, Than? Love you, Than. So, but give me some of your experience.
Yeah, I at the end of the day, it's what are you good at? What do you like to do? For me, I was butchering my way through single family because I thought that was the only approach. When someone said real estate investing, it's like, oh yeah, single family homes. I didn't really think about apartments because I didn't know the business. And I thought, when I have $100 million, let's talk, that probably would have been what I would have said in like 2009 or something, when I got started. And so the fact of the matter was, I was doing the flips, I was doing the vacation rental, I was doing the hacking, all this stuff, but I just wasn't a key player out there. I just wasn't that good. And so I didn't enjoy it. I didn't like anything about the process. I'm not a handyman. I'm not fixing my own stuff up.
Okay. That is so funny you say that, because that jumps right back to our conversation about C-class property. Because some of my students say, one of my students says, Charlie, I made millions in C-class. Why do you keep saying that? I said, yeah, but you own a tool belt. I don't own a tool belt, and I wouldn't know what to do with it. Yeah. So I hear you paying, Travis. I hear it. That's awesome.
Yeah. So that was the biggest awakening, is like, hey, I'm not enjoying it. This isn't what I set out to do. And my true goal was to be passive. And I really thought it could be. For whatever reason, I don't know. I just thought, hey, I'm going to have 50 single family homes, and that's going to be passive somehow. And I'm just going to collect mailbox money, but it wasn't that. And it wasn't a scalable model for me. And yeah, some people love the flips, and yeah, can you make millions in flips? Absolutely. I know people that do it, but that's not my game. It's like trading stocks, it's like, that's not going to be my game. Yeah. It's possible, but I'm not going to win at that.
Okay. So the thing is that, what you're kind of unique in the fact that you truly are passive. You put your money into deals. You have not sponsored a deal. So right. When, one of the things that I always correct people is a multifamily is not passive. It's a business. You've got to work at that business. Mm-hmm. The people who have sponsored your deals that you're in, they're working. It's not passive. They're making sure that the business runs. Right. But your model truly is passive. You're just, putting your money here and putting your money there. What type of distributions do you look for when you're looking at a deal? Yeah, obviously, it sounds like you need this income. You need the income that comes off these properties. So when you are looking at a deal, not so much from the quality of the asset, but more from how the offer works as far as the distributions go. How do you like to see it?
Yeah, absolutely. So I am very cash flow focused. That's the number one thing that I look at. As far as projections of equity 5-10 years down the road, who knows, right? That's kind of a bit of predicting the future, which I'm still mostly bullish on most of that. But I'm looking at specifically a deal that offers monthly distributions if possible. I love that. So most of the deals I invest in are monthly payout, and it's going to have a cash flow range, 7 to 10% maybe annualized cash flow that's being distributed, kind of like as a net result to me. Just kind of in a range like that. If it, you see deals with more of that heavy value add, on the front side, or maybe starting out with a really low occupancy for whatever reason. So accordingly, right, your cash flow is going to be much lower. So I'll usually pass on a deal that's going to have no cash flow the first year, or maybe a 2 or 3% year one, that kind of thing. I'm going to look for something stabilized out of the gate that's going to start distributing, as soon as possible. So that's what
okay. I hate this next expression, but I'm going to say it. I'm going to unpackage some of what you just said.
Okay.
Because it's really excellent stuff. So in other words, what I describe what you just said to my students is you've got to understand the flavor of the person's money. So Travis, your flavor is it must be a performing asset. You prefer performing assets. So
Correct.
don't bring Travis a complete value add proposition that has a great internal rate of return, 3 years from now, because that's going to be a no for you.
Right. In most cases, yeah.
And the other thing that you said is very interesting, because I had another a podcast guest on, and I can't remember his name. He was out in the Pacific Northwest, where he said the IRR, internal rate of return, which is really what you just mentioned by saying your future returns, at the end, can be anything, can be made up and what have you. This guy said the exact same thing. He said, I don't even look at that number. It says that number is a made up number, because you can manipulate the cap rates down there. You have no idea what the NOI is. I want to know what my cash on cash return is. I want to know what my distribution is going to be every year, because that tells me everything about the property. And so that's so interesting that you said the exact same thing that he did. When you're looking for that type, well, you look surprised, like
well, smart guy. I'm thinking, wow, got some
and
quality people
and
on
good
this
looking
show
too, Travis. Let's throw it all in there too while we're at it. Go ahead, for crying out loud. Oh my gosh. So listen, you can be found at www.ashcroftcapital.com/, passive investor. That is, what does that get me if I go there?
Yeah, so that URL you just named out there is a free passive investor resource guide. So it's a lot of the stuff that we're talking about here on the show. It's how to vet a sponsor, how to vet a market, what types of deals there are, all that kind of stuff. So I think it's like a 20-pager PDF, just totally free as a download.
Awesome. Listen, every one of my students or anyone thinking about raising private money should download this package. Not so much because, you are in a unique position. There aren't many guys like you that just do it strictly passively. It's so cool to get your perspective on it. But most of my students and most of the people listening want to get in the business and want to become sponsors and want to get their first deal. Folks, you got to get the intelligence on guys like Travis and finding out like what makes him tick and what makes him think. So you all should be downloading this program. Let me give it to you again, and it'll be in the show notes. We'll make sure that's in the show notes. It's www.ashcroftcapital.com/passive investor. And that's Joe Fairless's organization. So good stuff. Travis, thank you so much for being on my show.
Thanks, Charles. I appreciate it.
As I say, and you can tell Joe Fairless is the fastest growing multifamily podcast in history.
I'll be sure to tell him. Yeah.
Something tells me you're not going to. Well, Travis, it's so good to see you again. I'm looking forward. Hopefully our paths will cross again. I've had a blast talking with you. You're a good guy. And thanks so much. Talk to you soon.
All right. Thank you. Take care. Man.